to FEI Long Island Chapter's November 2014 meeting. I'm Vincent DeVito, the chapter president. FEI is a nationwide organization with over 11,000 members dedicated to helping CFOs, controllers, and other financial executives. FEI provides many benefits to its members, including hosting world-class conferences and events, influencing policy at the highest levels such as the SEC, PCAOB, and FASB, providing electronically available research on emerging and current issues, providing online education including CPE credits, publishing the award-winning Financial Executive magazine, providing a career center, resume bank, and job center for all levels of financial executives, and providing discount programs for cars, hotels, and more. The FEI Long Island chapter holds 3 events monthly, or co-hosts 3 events monthly. One is a large educational event, typically like today's, for example, with compelling speakers or panel discussions and networking opportunities open to members and non-members. The second is a CFO roundtable. It's usually held the second Tuesday of each month. Our next meeting will be is scheduled for December 9th. These are held at the Abrams Fensterman's office in Lake Success. These are confidential, issue sharing, and networking exclusively for members and other financial executives. If you're a CFO who has not participated in these, we really urge you to come and see them. It's really a unique event that FEI Long Island holds. The third event is a roundtable for public companies. These are held at BDO's offices in the Sbarro. We'd like to thank our growing list of sponsors, including BDO, Robert Half, Abrams Fensterman, Paychecks, Red 3 Consulting, and FinTech. So, Charles Scarallo is a tax supervisor at Sheehan and Company, which is an independent member of the BDO Alliance. Charles specializes in providing income and estate tax planning for high net worth individuals and designs strategies for wealth accumulation and tax efficient wealth transfers. Charles joined Sheehan and Company in October of 2011 after gaining several years of tax planning experience in a large regional accounting firm. Charles is a CPA and is in the midst of achieving his MS in taxation. During his time at Sheehan and Company, he has gained valuable experience in taxation with a focus on income, estate, and gift tax planning and compliance for individuals and closely held businesses. Charles?
Sure. I just need to grab that little clicker up here. Thank you. So, good morning, everybody. Thank you for having me today. Just a little bit about, besides me, about Sheehan and Company, where I work. Began business in 1955, and through steady growth have become a well-known and respected firm in the New York metro area. With offices conveniently located in Bright Waters, New York, Midtown Manhattan, and Port Washington, Sheehan and Company delivers professional services to clients around the globe. Our mission statement is that we deliver highly personalized and professional services. We make every effort to enhance client profitability and the personal net worth. We continuously invest in our employees and technology to remain on the cutting edge and ever-changing business world. We sincerely value the opportunity to share a wealth of knowledge with those who seek it. And we're a full-service CPA firm, so in addition to the tax services, we offer financial planning, accounting and auditing services, computer and technical, business valuation, and litigation support. And in addition, there's a second arm to our company, which is Sheehan Financial Advisors, which my partner, John DeFalco, who's in the audience, heads up financial advisory. And it's a team of tax and financial advisors available to assist business owners with tax and business continuity and contingency planning. We offer comprehensive wealth management services to business owners and their key executives. And just one more little fact about the Sheehan and Company is we're a member of the BDO Alliance, which I think gives us a greater reach, almost a worldwide reach, and it benefits our clients because we have the collective knowledge and experience of BDO, a national and international network of firms, so long history of providing exemplary value-added services to their clients. The BDO Alliance allows Sheehan and Company to tap into this network of businesses and advisors to help meet our clients' existing and expanding needs. So that's just a little bit about the firm and where we're coming from. Going to now jump into the the meat of the presentation. I'm going to cover some federal, estate, and gift tax rules, touch on the New York State changes, and then from there go to a quick individual planning update and a corporate planning update. So a lot to cover today. Anytime you have any questions, I'm going too fast on anything, please just stop me and hopefully can answer them. So we're at on the federal level, we're at a $5,340,000 lifetime exemption. And this is combined lifetime gift tax and estate tax. So what that means is during my lifetime, I can choose to give away this $5 million free of gift tax. If I choose not to use it or don't use all of it, whatever remaining credit I have will be applied against my taxable estate and offset any potential federal estate tax liabilities. So you and your spouse each have $5,340,000. So you have about $10 million that could be given away during your lifetime or excluded from both of your gross estates. So in addition to that, we have a federal gift tax annual exclusion, which is $14,000 per donee. And you can also use the tool of gift splitting, which allows you to give $28,000 to any donee during the year. So it doesn't seem like a large amount, but can be pretty powerful when you're adding multiple donees. And this is an unlimited amount of people that you can give this $14,000. I'm always accepting $14,000 annual exclusion gifts if anybody would like to give me. But we have this large lifetime credit, but we can even preserve that sometimes just using the $14,000 per year. I know portability of this large $5 million exclusion, this came out of the 2012 Taxpayer Relief Act. And what it does is if during your lifetime you don't use your entire exclusion and your estate rolls around, you pass away, you don't use your entire exclusion, your estate is under the $5 million, whatever unused amount passes to your spouse. So effectively you can defer the paying of estate tax if you're under your combined exclusions until the second spouse's death.
Does that do away with a lot of the trusts that people used to set up in order to kind of preserve the...
Like a credit chapter trust?
Correct, correct. I'm going to go over that a little bit later. I'm just going to try and highlight a couple things, but I'll go over the advantages and the disadvantage of using credit shelter trust versus just solely relying on portability. And then we have the step up in basis, which you get at the date of death. And this, I think, is becoming one of the more focal points of estate planning since the increase in the capital gains rate up to 20% and the addition of this new Medicare income surtax of 3.8%. So with the combined amount of 23.8%, it's becoming a lot more significant what the basis of the asset is going to be, and trying to utilize the basis step up in the planning and not just solely rely on avoidance of federal gift tax or federal estate tax. And again, I'm going to come back. I'm just going to highlight a few items, and then we're going to go into them in a little bit more depth. And then we have the states to worry about. Currently, we have 13 states that still have an estate tax, New York being one of them. And as of April 1st, 2014, we've increased the exemption in New York State to $2,062,500, and it's going to increase annually through 2019 until it matches up with the federal exemption. And I guess we went from $1 million to $2,062,500, but when I go into this a little more detail, it's not as great as it may seem. So, to your question, why plan when we have portability? States greater than $12 million, they're most likely going to be in a taxable estate issue, will probably rely on items like the credit shelter trust or previous, or techniques used previous to this law change, or grantor trust planning, GRATs, grantor retained annuity trust, and family limited partnerships. And these are the tools that we've been using pretty much all along, and specifically grantor trust planning and GRAT planning have been very advantageous lately since the interest rates have been so low. So in a low interest rate environment, we usually, the GRAT, I don't have enough time to go into full detail about it today, but can really be a home run. So now we have the estates in the $2.5 million to $12 million range, which you would think could probably rely on portability, but it's not always so cut and dry that I can just have a will that gives everything to my spouse, and my spouse is going to give everything to me, the I love you will. And in blended families, depending on how the age of the spouse, the spending of the spouse, the assets that the spouse owns, it's not always advantageous to use the portability, so we'll use the credit shelter trust approach. And the credit shelter trust, for those that don't know, is a trust that you set up 2 trusts with the estate. On the first spouse's death, you're gonna fund 1 trust up to the lifetime exclusion. So if they died in 2014, we would fund it with the $5,340,000. And then any amount of the first spouse's estate that's above the $5 million, we're going to fund with a marital trust and apply the marital exclusion. Now the marital exclusion is unlimited. I can give to my spouse up to any amount. In addition, I could gift during my lifetime any amount to my spouse, free of gift tax, free of estate tax. So we effectively pay no estate tax on the federal level on the first spouse to die. The second spouse passes, whatever assets are left in that marital trust that we applied the marital deduction against is taxable in their estate. So we've deferred the paying of the estate tax until the second spouse dies. We paid no federal estate tax on the first death, we paid it all on the second. So what are the advantages of using this versus just using portability? We have an estate tax freeze. So on the date of death, we're going to freeze the estate. We're going to say this is what the value is, this is what I'm going to either pay tax on or pass into a credit shelter trust and use the marital trust to avoid any tax payments on the first death. And any appreciation that happens after the date of death is passing on estate tax free. Primarily, we'd like to do that in the trust, the credit shelter trust, rather than the marital trust, since the marital trust will be taxable in the second spouse's death. But we can pass on appreciation free of estate tax, and hopefully that estate tax won't be paid until a second generation passes on. We can utilize state exemptions. Now, in New York State, we don't have the use of portability, and the exclusion amount is much lower than the $5 million. So if you're not in a federal taxable estate issue, but are definitely in a state taxable estate issue, you would utilize credit shelter trust planning to avoid the payment on the first death. Maximize the use of GST exemption. Again, I'm not going to get too into this, but it's just the generation skipping tax is if you're passing assets onto a skip generation, would be like passing assets onto grandchildren. You have a separate exclusion amount that you need to use when you do that. They're trying to avoid you from passing on assets to a skip generation and just deferring the payment of estate tax or gift tax that much longer. And it works better for blended families. If you have a second spouse and you have children with the first spouse, using credit shelter trust planning assures that your assets when you pass are going to go where you intended them to do. If you rely on portability, you're relying on your current spouse to take care of the children from your first marriage, which sometimes works, sometimes doesn't work. But with the credit shelter trust planning, you can really assure that the assets go where you intended them to. And then you have asset protection, as you would with any trust. And this could be asset protection against creditors. It could be asset protection against the beneficiary that you believe is going to spend down the money quicker than they should. So we have these advantages to credit shelter planning. So why use portability? Administrative simplicity, I think, is the biggest thing. And I think that was the real intention of giving portability to taxpayers, was to simplify the process when somebody passes. And in addition, we get a second step up on the second spouse's death which again is imperative, I think, at this point to estate planning. So I'm going to speak a little bit now about the basis planning and optimizing paying capital gains tax versus paying estate tax. I think we're kind of creating a balancing act now of how we can take advantage of the step up in basis and whether sometimes it's more advantageous to just pay estate tax and get the step up in basis rather than try to create a plan that's avoiding paying estate tax. So there's this, I guess, new math now in estate planning, since the differential between the income tax cost of selling an asset and the combined federal and state tax rates is small. Like I said, we've increased from a 15% capital gains rate to a 20% plus the addition of the 3.8% Medicare tax. So historically, planning prior to these rule changes, we would try to use the lifetime exemption as quickly as possible, and the basis step up was less important because of low capital gain rates. Income tax considerations were secondary in the estate planning. Estate planning is infinitely more complicated than it was in the past, depending on a wide variety of variables, such as how long the client lives, spending, size of the estate, investment returns, income tax character of assets, expected time of the sale of assets, investment and non-investment income related amounts, and the state of residence. So we have a lot more to think about now. And in planning to do this, I think you're going to have to be a lot more coordination between your estate planner, your attorney, and your investment advisor to, I guess, find out the character of the assets that are going to be in your estate, as well as what the basis of those assets are. And in planning, if we want to gift away high basis assets, preserve low basis assets, and get the step up at the date of death. And if not, if you're charitably inclined, also give away highly appreciated assets and avoid paying an income tax on the sale of the asset. Then we have the New York State changes here. And you can see in the little chart here on the bottom, in 2019, we're going to meet the federal estate tax exemption. And I think the initial thought behind this, or at least how it was sold to the taxpayer, was that we were going to try and keep our wealthy individuals in New York. Hopefully they'll die in New York rather than leave the state to die. And that's where we got the move to die tax. Broaden the tax base while they were here, collect income tax on their earnings while they're still alive, and I guess bring more revenue to the state. But I think it fell pretty far short of that, at least initially it's going to, with this estate tax cliff. So if your estate is greater than 5% of the basic exclusion amount, you're potentially worse off with the new law. You're going to have a phase out of the exclusion amount, and you'll either be right back where you were with the original $1 million. Sure.
Quick question. Now, currently, in New York State, if you go over the $2 million, you're taxed to $1, unlike the federal. When it gets to equal with the federal, would it go to $1, or will it start at?
Well, I think you'll still have that. Your threshold will be much larger. You'll be at the $5 million or whatever it is.
$1.
Correct. So you'll have a phase out if you're greater than 5%.
Mm-hmm.
Obviously, now with the exclusion only at $2 million, it's a lot worse than if it's at $5 million. I think it's going to pull a lot more people into a potential taxable estate that weren't intended to. I'll give a little example here of how that'll work. So if you die in 2014, taxable estate of $2,165,000, so that's just 5% over the $2 million exclusion that New York State's giving you. You'll have an estate tax of $112,000 here, right? And you're only over the exclusion amount by $103,000. So that's an effective marginal estate tax rate of 109%. So I think it's kind of undone itself with what the intentions were for the law. Whether or not they can agree to terms of fixing that, can't speak to that
Was
yet.
that an unintended consequence, or was that a?
It's very tough.
Is it a feature?
It's very tough to tell. I mean, like I said, I think they sold, exactly, I think they sold it as trying to avoid
Quickly.
people from doing
You're
that.
on deathbed.
I am on JetBlue to Florida.
Well, that's what I'm thinking. Where were you in the air when you died? It's terrible.
And in addition, I think this is also a big part of it, the gifts being included in your taxable estate. Previous to this, New York State has no gift tax, and we continue to have no gift tax, but your gifts were never pulled back into your estate. So you could effectively make a deathbed gift the day before you died, give away all your assets, and pay no New York State estate tax if you did it properly. But now, any gifts you give within 3 years of your life, of your death, are going to be pulled back into your estate. Now, there's a small window that this is going to happen. It's between, I think, April 14 and December 18. So I guess we have to wait and see whether or not they're going to extend that or not. I mean, something I could definitely see them extending out of all the provisions of these changes, since those deathbed gifts were so beneficial to people, and if done properly, you were able to avoid all New York State estate tax. But as of now, if you die between these dates and you've gifted anything away within 3 years of the date, it's going to be pulled back into your estate. So, estate planning with these new changes, married couples with less than one of the basic exclusions. So if your estate between you and your spouse is under the $2,062,000, you're fine. You're probably not going to be in a taxable estate issue. You can use the I love you will that we spoke about, where you just pass everything to your spouse passes everything to you, and keep it pretty basic. I mean, unless there's other driving factors as far as asset protection or blended families, you should be okay with a basic estate plan. But once you come above that $2,062,000 or even potentially the $5,250,000 when they meet the federal exclusion, it gets a little more complicated. You can actually wind up missing out on a lot of estate tax savings if you don't properly plan with maybe credit shelter trust planning or some other estate tax planning tactic. And now we have issues with gift giving with the 3-year advance. So to avoid this, we can make gifts of real tangible property outside of New York. So if you have any homes out of New York or any tangible assets that are located outside of New York, you can gift those away. They're not going to be included in the gift tax add back for New York State purposes. And we can consider holding off on large gifts until after this law expires, but as I said, there's always the possibility that this could be extended.
Or you could die before.
Correct, but if you were, you can not do any gifting and die before, but I guess you'd be left in the same
And I think
position
you want to stay on
regardless.
the equipment until after 2018. Stay alive.
And then we always have the annual exclusion gifts. So the $14,000 gift, New York State's going to recognize that and won't add that back. And you can also use payments of qualified tuition, medical expenses, and charitable gifts in addition, and they're not going to be added back. And just another note on the qualified tuition and the medical expenses, if they're paid directly on behalf of somebody, they will not be included in federal gift tax as well. So there's an exclusion for that. So that's it for New York State and federal. I'm going to move on to a quick individual tax update. If anybody has any questions on what we just previously went over, I can come back.
There's still no requirement for there's no filing requirement for up to the 14,000, but if you split a gift, there is a filing requirement to at least notify.
If you're both under, you should be okay without. If you're combined or just annual exclusion gifts, you should be okay.
Oh, okay.
Yeah. Any other questions?
What's the exclusion for like Medicaid, like is it 3 years or 5 years?
As far as the look back,
Yeah.
it's more of an elder law question. I think it's,
I think it's up to 5
Yeah,
years.
I think it's 5 years,
Yeah.
okay, so let's jump into the individual tax act update. So all these federal state tax laws I was speaking of and the changes, they all came from the American Taxpayer Relief Act of 2012, and it brought us some level of certainty. I think there was a big scramble at the end of 2012 of whether or not certain provisions were going to be extended, and people were trying to do a lot of planning to, I guess, mitigate any effect of an increase in tax rates. So we did get an increase in tax rates for the tax marginal, the top marginal rate up to 39.6% now. But for 2014, that's going to remain the same. So I think back in 2012, the idea was to accelerate income and pay it now at the lower tax rate. But now I think we're going to go back to the school of thought of trying to defer income and accelerate deductions, which was something that wasn't happening prior to this law change. And with it came the itemized deduction limitation. So there's a phase out of your itemized deductions for, I guess, wealthier individuals with $305,000 of AGI. There's going to be a AGI, 3% AGI phase out of your itemized deduction. So you have a floor. If your AGI is 300,000, 3% of the 300,000 will have to be excluded from your itemized deductions. So you are losing some of the benefit for wealthier individuals. And the same thing's happening with your personal exemption limitation. Also going to be a phase out of that for the same threshold, 305,000 for married filing joint. We got permanent AMT relief from the act as well. I think every year we had this scramble of whether or not Congress was going to, in time, extend the AMT patch, what they called it, which was an increase in the threshold of who's going to be pulled into the AMT. And there was always a question of if millions of people are going to wind up in the AMT this year. But what they did was they made it permanent and they indexed it for inflation, so there's not that scramble at the end of the year of whether or not Congress can get together and pass the legislation. And now, I spoke about it on the estate planning side, but also on the individual tax side, we have the Medicare surtax. And this came from the Affordable Care Act. And it's a 0.9 increase to payroll tax and a 3.8% increase on unearned income, taxation of unearned income. So for the 0.9%, it's for high wage individuals, and it's going to be an increase on the Medicare you're paying on your wages. For married filing joint, over $250,000, and single taxpayers of $200,000. So it's just an additional 0.9% you're going to pay to Medicare. And we have the 3.8% Medicare contribution taxes imposed on unearned income of individuals, and it's a 3.8% tax applies to the net investment income of individuals with modified adjusted gross income that exceeds $250,000 for joint and $200,000 for single. Now, it's not just on interest and dividends, which I think it's got a little bit further reach than that. It's on any passive activities you have. So if you do own a rental property that you don't materially participate in, and it's considered a passive activity, or if you have any other passive partnership investments, this 3.8% Medicare surtax is going to be charged against any of that income, assuming that your AGI exceeds the $250,000. So it does have a little bit wider of a reach than just on investment income like interest and dividends and capital gains. So when we're planning, now we also have to plan for AMT, we have to plan for our estate, now we have to plan for Medicare surtax as well. So you need to discuss your portfolio with your investment advisor, understand the impact on your total return, adding another layer of tax with this 3.8%. So when you're tax affecting your returns, they might not be as good as they were.
Bus 4 is here.
And in addition, I think that makes some municipal bonds maybe more appealing once you tax affect the cost of owning the bond. since the corporate bonds are excluded from, I'm sorry, the municipal bonds are excluded from the 3.8% Medicare tax. We can also maximize our qualified retirement account contributions if we're not already doing that, and it could potentially pull us under the $250,000 or $200,000 threshold, and we won't be subjected to the 3.8% Medicare surtax. And we can use life insurance for tax deferred or even tax-free benefits when we're planning. So just have a couple of corporate tax updates I want to go over as well. I think the biggest thing that's happened, the biggest development, and this is just as of recent, in September, we just got new regulations from the IRS, the Treasury Department, on the capitalization of repair and maintenance, property, plant, and equipment. So I think most taxpayers, most corporate and partnership taxpayers are going to fall into these rules on some level. And what it's done is given guidance as to what amounts need to be capitalized, what amounts can be expensed as incurred for tax purposes. And it's pretty much going to require most taxpayers to have a capitalization policy. And I think you should definitely be in discussions with your advisor, your tax advisors, regarding creating that policy and any safe harbors there are to that policy. This is something that we could probably spend the full hour on. Just kind of wanted to make you all aware of that if you're not already. And big change to Section 179, which has been something that's very advantageous to business owners. Back in 2013, we were able to purchase $500,000 of equipment. As long as we didn't purchase more than $2 million, we could expense all that equipment right on the spot. They have not yet extended that provision. I think there's talks to do it. I checked, I think, yesterday or the day before, and they still have not extended it. So we're going to go back to the old amount, which is only $25,000 with a $200,000 cap on capital purchases. So I think we should hope that they do extend it, but as of now, I think we have to plan for $25,000. Any questions on anything I've touched on today?
Self-employment tax
Sure.
for a partnership hinges on active versus passive.
Correct.
So you have the, so I mean, if there's any planning to be done about the designation of somebody active and passive, they're kind of conflicting, right? I mean, on the one hand, we've got no Social Security taxes or self-employment taxes if it's passive, but you'd be paid a Medicare surtax.
Correct, and sometimes, I mean, you can wind up in a position where you've already maxed out your, the bulk of the FICA that you owe, and
Right.
the 3.8 is greater, but I mean, you really need to legitimately look at the activity of whether or not you are employed by this activity or it's subject to SE tax. You really can't optimize between the two.
Right, but I mean, if there's any planning to be done around that, if you're anywhere near the border, or you've got an opportunity to plan around it, I guess.
Correct, it can be very advantageous. I mean, we've seen it in projections, yeah, that sometimes paying SE tax is more beneficial than paying the 3.8%. Any other questions?
Thanks very much, Charles.
Thank you.
Okay, so I want to thank everybody for attending. Again, a reminder, the upcoming events, we have Islander Night that's coming up on Monday, December 15th. We'll get out some definitive information on that, but tentatively 6 o'clock at the Nassau Coliseum. And after that, January 21st, we have a session. Actually, Neil will be hosting that session. There'll be a panelist on that session concerning mergers and acquisitions. We have our next CFO roundtable at Abrams Fensterman, scheduled for Tuesday, December 9th. And the next CFO roundtable for public companies will be held at the Scarallo building in Melville on December 16th. Do we actually have a topic set for that one yet?
Email go out.
I'm sorry?
I'll send an email out.
Okay, great. Great, thank you. And once again, we'd like to thank our sponsors, BDO, Robert Half, Abrams Fensterman, Paychecks, Red 3.